Our session today will focus on exploring the topic of principal component analysis, commonly referred to as PCA. So what I'm going to do is use the website as a perfect example for you. I'll select a group of variables that are all interconnected and pertain to a single core concept. So, the main idea behind PCA is that we can effectively reduce the total number of these variables. It essentially functions as a powerful dimensionality reduction technique. However, it's important to note that it does not establish any direct causality. Just imagine if we have a very large number of variables at our disposal, we can often reduce them down into a much more meaningful, smaller set of variables. So, allow me to provide you with a clear and concise example. Let's begin by considering the crucial connection between a company's overall profitability and its stock return. And when we're looking at this, we actually have quite a few different ways to measure a firm's profitability. For instance, just to give you an idea, I can simply begin typing the term profit. And from the options that appear, I'll select any variable that's directly connected to profitability. I selected the return equity, the fluctuation in profit margin, gross profit as a percentage of assets. Let's adjust the gross margin by subtracting revenue. Overall operating profitability. Gross margin. Cash operating profitability. Ratio of operating cash flow to the average of total assets. We should analyze the earnings price. Cash productivity. I believe we can confidently bring our current enumeration to a close by including the crucial metric of return on asset. I'm quite certain that this selection will be perfectly adequate for our purposes. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 distinct items here. And from these, I'm going to apply principal component analysis, or PCA, to effectively summarize all of that information into a single, more manageable variable. So to do that, I'll scroll down to the PCA section. And for this next step, I'm going to proceed by selecting all of the X variables that I had previously defined and set up earlier. So, I will then make the decision to select just one primary principal component for our analysis. It's very important to consider that if you have variables that operate on different scales, for example, if one represents a precise decimal profitability measure and another is simply a ratio, meaning they inherently have distinct scales, then it becomes absolutely essential to standardize them prior to executing the PCA. If you don't do that, then the PCA results will not be accurate because it will inherently gravitate towards those variables that possess a larger scale, and it won't necessarily focus on the variables that hold greater importance when it comes to determining profitability. So I standardize the data before running the PCA, extracting one component, then I create the PCA components. It has now been successfully created. The primary reason you observe a mean value here is because we first demeaned each variable by standardizing them prior to executing the PCA. So it's entirely natural to find a mean that is very close to zero for the resulting PCA components. However, what truly holds greater importance when analyzing the PCA is actually the inherent variation exhibited by that particular variable. Moving forward from this point, we will be able to perform a regression analysis to clearly identify the underlying relationship that exists between a firm's profitability and its stock market returns. But before I proceed with that, I always prefer to first normalize the y variable just to ensure that I don't have any outliers. So what I need to do is navigate to the specific section designated for transforming variables. From there, I will proceed to select the option that says Enable Once Rising, and by doing so, this action will then cause the y variable to increase its value. It is currently at 1%.
Our main goal is to ensure that we don't have any unusual data points.
Eddie. Then I create the once raised variable. I will proceed by scrolling down to the OLS regression with the specific purpose of thoroughly examining the underlying connection. So, the primary dependent variable that I have chosen, which we are calling y, is specifically the annual stock return. Pause. Therefore, rather than selecting all of these individual related variables, the fundamental idea is that you can effectively summarize them all into just one single comprehensive component. And then I run the ordinary least squares analysis. And now I present the results of our investigation. Our analysis indicates that profitability exhibits a strong positive relationship with stock return, as the p-value we observed is statistically significant at the 5% level. This means that the likelihood of these results occurring by chance is very low, since the p-value we found is indeed less than 5%. So that's the core concept behind principal component analysis. Thanks for watching.